Imagine this. You sell a property and $400,000 hits your checking account. You breathe easier. The money is finally safe. But here's what almost no one tells you. At that exact moment, $150,000 of that money may already be completely unprotected. Not frozen, not delayed, simply uninsured. That FDIC sticker on your bank's door doesn't mean what most people think it means. It isn't a blanket guarantee, it's a rule book. And buried inside that rule book are limits and conditions that can quietly expose your money to real risk. We're conditioned to believe that money in a bank is the definition of safety, that once it's deposited, it's protected. But that sense of security isn't accidental, it's engineered. Modern banking runs on public confidence. Your deposits are the fuel that keeps the system moving. This isn't about fear or predictions, it's about clarity. We're going to look at how bank safety actually works, not based on assumptions, but on the rules as they're written. Because real financial security isn't a feeling, it's an understanding. Let's start with the FDIC's $250,000 insurance. Most people assume it's simple. The government insures their money. But the reality is far more precise and far more limited. Coverage is $250,000 per depositor, per insured bank, per ownership category. That last phrase, ownership category, is where most people get caught. All of your personal checking, savings, and CDs at one bank usually fall into a single category. If those accounts total $300,000, $50,000 of that money is uninsured if the bank fails. That's not a technicality. That's exposure. Before today, did you actually know how these ownership categories worked? Let me know in the comments. Yes, coverage can be increased. A joint account with a spouse is treated as a separate category and can be insured up to $500,000. But that protection only exists if you understand and actively manage the rules. And if a bank does fail, the FDIC is typically fast with insured funds, but anything above the limit turns you into an unsecured creditor. You're issued a receivership certificate and forced to wait, sometimes months or even years, with no guarantee of full recovery. The collapse of Silicon Valley Bank in 2023 showed this isn't hypothetical, it's procedural. Now, let's go deeper. Here's a structural reality most people never confront. Once you deposit money, it doesn't sit in a vault waiting for you. It's deployed. Banks lend it out immediately. This is fractional reserve banking. And since March 2020, the Federal Reserve has set reserve requirements at 0%. That means banks are no longer legally required to keep any portion of your deposits in reserve. Your entire balance can be used to fund mortgages, corporate loans, or government bond purchases. The system only works as long as people don't ask for their money at the same time. When that confidence breaks, access, not ownership, becomes the problem. That's exactly what happened in March 2023 with SVB, Signature Bank, and First Republic, three of the largest bank failures in U.S. history. SVB followed a chain reaction. It bought long-term bonds when interest rates were low. When rates rose, the value of those bonds fell. Depositors rushed to withdraw funds. The bank was forced to sell assets at a loss, and the gap became fatal. If this analysis is helping you see the system more clearly, consider subscribing. We focus on structures, not headlines, so you can make decisions based on how things actually work. The events of 2023 were a warning tremor. A much larger pressure point is building quietly in the background. By the end of 2027, more than $1.5 trillion in commercial real estate loans are set to mature. Many were issued when interest rates were near zero. Now those loans must be refinanced at far higher rates, often on properties that have lost value, especially office buildings impacted by remote work. Refinancing a depreciated asset at higher rates sharply increases default risk. And this matters because regional banks are heavily exposed to commercial real estate. Stress here doesn't stay contained, it spreads through lending, credit availability, and liquidity across the system. This isn't speculation, it's a structural bottleneck the financial system is already watching. Understanding these risks isn't about panic, it's about control. I'm not telling you what to do, I'm showing you how the system operates so you can make informed decisions. First, understand FDIC limits precisely. Holding more than $250,000 in one name at one institution creates concentration risk. Second, use ownership categories intentionally. Individual accounts, spousal accounts, and joint accounts are treated differently. Tools like the FDIC's ED calculator exist for a reason. Verify, don't assume. Third, know what insurance does and does not cover. FDIC protects deposit accounts only. Investments are not FDIC insured, and brokerage protection through SIPC has its own limits and conditions. Fourth, confront inflation directly. Even in a perfectly stable bank, cash earning less than inflation is losing value each year. Safety isn't just about avoiding loss, it's about preserving purchasing power. The security banks offer isn't a guarantee, it's a framework with boundaries. Your money isn't stored, it's utilized. And it's subject to thresholds and systemic pressures most people never examine until they're forced to. If this perspective feels new, that doesn't mean you were careless, it means the system worked exactly as designed. By understanding the rules, spreading exposure, and thinking beyond simple balances, you move from blind trust to informed control. Comment "Verify" if this changed how you think about bank safety. Now that you understand how bank safety actually works, the real question is what comes next. In the coming videos, we'll break down how wealth is protected and built outside the traditional banking system. If you want to see that analysis when it drops, make sure you're subscribed and notifications are turned on. Thanks for watching.